Alrighty guys, what is going up? Welcome back to the Best Investing Money Management channel on YouTube. Now in today's video, we are going to be talking about Lucid Motor, ticker symbol LCID. This stock over the past day has been virtually going parabolic. You can see this massive amount of growth, up 23%. We're going to be talking about should you buy, should you sell, and honestly some good investment strategies, support resistance, and pretty much everything you must know before you invest into this company. So I hope you guys enjoy it. If you have any questions, ask them down in the comments. And guys, make sure you guys smash that like button because at the end of the day, it really helps me out when you guys do that. So starting off, what is Lucid Motors? You can see the company is a electric car manufacturer. It's almost like it's supposed to be a little bit better than Tesla. That's what everybody's saying, just because they're supposed to have better batteries, right? The average car is going to be actually being able to drive over 100 miles longer than Tesla just because of the battery. And the cars are going to be relatively around the same price, anywhere from about $50,000 all the way up to well over $100,000. So the company came out today and said, hey guys, we're still on track to have production plans for 2022, which made investors say, hey, that is fantastic because this has been such a long wait for this car. It seemed like they kept pushing it back, and then they came out and said, hey, we're still on track, just so you guys know, which had investors go crazy, and obviously we had this massive amount of buying pressure. Not to mention the company did come out and say, hey, another thing, we have been absolutely killing it for reservations for the first vehicles. And now everybody said, okay, well, they're still on track for production. They're hitting all of their numbers for reservations. So look at this, man. The stock jumped 23%. Now, when it did that, it had a market cap right at around $89.9 billion. We can round up to say $90 billion. So that is pretty much how much this company is worth. And that is more than Ford, and GM is right at about 90.9. For this company right now that virtually doesn't make any money, the company's worth close to $90 billion, which, hey, in my opinion, I think it's a little overvalued, but hey, it's kind of what everybody wants. Everybody wants that next Tesla, that next company that's going to take off and be the front runner of that sector. And Lucid could very well be that company. But right now, there's a ton of competition in the field. Virtually every auto company right now is mainstream on electric vehicles, which is going to slowly start taking up more and more market share, which at the end of the day, that's where front runner advantage, is super large. So that's why Tesla is as large as it is, because they were that company that came out with only electric vehicles. So they had that really large lead, which made the company, sought after by investors. Everybody loved their cars, very high technology cars, autonomous driving. And they're a lot more than the Tesla, than electric cars. They're Tesla Solar. They're a variety of things. So front runner advantage is very, very large, and everybody loves to just compare electric cars to Tesla, which I get it, just because they're that front runner. They're that the pretty much the largest electric car manufacturer right now. But hey, right now I really think LCID Lucid is going to be a solid stock for the next couple of years. I definitely think it's going to be one that is going to be a little bit of a higher risk, higher reward, because the company hasn't made any cars yet. When Tesla first came out, they had a ton of production problems, and their reservations just kept getting pushed back. And even though they came out and said, hey, we're still building cars, we're just having problems with batteries, with this, with that. Hopefully Lucid doesn't have that, but there's a very large possibility that they do, just because they don't have any production. Not to mention, right now, company makes $0 in revenue, so I definitely think that's going to make this company, more of a speculative play for a company that's worth $90 billion. But breaking down the support and resistance on the technical side, you can see it has clear resistance at about $64. That's that high. It's going to be a very hard, price point to break above. You can see it's hit it. It's sold off. Some support is going to be right at around 50. 50s and 100s do tend to act as support in resistance. I do think another support, is going to be 40. You can see it hit it as resistance, curled up above it, and then used it as support. So that old resistance right in here, hit it as support, and definitely bounced up. Not to mention, every time this stock hits the red on the RSI, we have a tendency to see sell-off, shortly after. So right in here, you can see it came up, sold off. Right up in here, so it came up, sold off. And then all the way up here, we had this major sell-off back down to some undervalued territory. So should you buy it? That's the main question everybody wants to know. I definitely think Lucid Motor is going to be a stock that's going to be around for a while, but you have to do it with a strategy. So in my opinion, I think dollar cost averaging would be a fantastic investment strategy because you can use the volatility of Lucid to your advantage, right? So pretty much what you do is you figure out, hey, I want to invest $500 or $1,000 into this company. So instead of putting up that $1,000 all up front, what you do is you pretty much just invest $100 a week over the next 10 weeks, or you can do it monthly, $100 a month over the next 10 months. So what you do is you develop an average base for those shares. So you get a good average price for those shares for that time period. So if the stock continues to go up like it did in here, you still make money, but the beauty of it is when it sells off, you're continuing your investment. Okay, so now you're getting your average share lower and lower and lower and lower. So once the stock recovers, just like it did in here, you make a lot more money. And I think it's a fantastic strategy for this stock. And me personally, I wouldn't go more than about 5% of your portfolio into something like this, just because of the overall risk that it's going to be taking. And really what that means is if you have $100 in your portfolio, don't put more than $5 in the stock. And if you have 1,000, don't put more than 50, and so on and so on, about 5%. Not to mention, if you find it's very hard to pick and choose all of these electric startups and, autonomous driving cars, honestly, don't be afraid to look up dividends. Dividends are a fantastic way to grow your portfolio, but not have to worry about picking and choosing different stocks. So a company or an ETF like DRIV virtually has all the electric startups in it, and it's just rationed out so you get a little bit of a piece of the pie in the whole sector. It's a lot lower risk, but still carries so much reward. I highly recommend this as well. So guys, that is it. I hope you guys enjoyed the episode, and if you did, hit that like button, subscribe to the channel, and we will see you guys later. Remember to stay happy, stay positive, and stay safe. Take care.